Hey guys, I'm Duncan Wilson.
And I'm Sasha Syed, and you're listening to the Mortgage Sweet Spot Podcast, proudly presented to you by Mortgage Suite.
This podcast is your go-to source for expert insights, innovative strategies, and the latest mortgage trends to help you make the most informed decision regarding your mortgage financing. Whether you're a first-time home buyer, a seasoned real estate investor, or maybe somewhere in between, you've come to the right spot.
So sit back, relax, and get ready to discover your mortgage sweet spot.
Yeah, so we're back on our third beautiful episode today, and fourth? Oh, shoot. Maddie's telling us it's fourth or fifth. I feel like I've only done three with you, buddy. I don't even know.
I think we've only done 3 so far, right?
Okay, well, regardless.
What?
This is where we take the articles that are the most searched and sought after on our website, and we kind of produce a cool video to them and talk about those videos. And today, like Sasha said, we are doing self-directed mortgages today. What are they? How do you get them? What are they? How do they work? And then what are they?
Yeah.
I've done quite a bit of them in my career, so we can start off, and Maddie always produces this beautiful checklist to go through, make sure we get the most content to our viewers, you guys. So let's just start off. Let's define a self-directed mortgage. Okay. So a self-directed mortgage it could be many things, but it's where an investor's taking their money and placing it on a property. And it's usually done on the private side. So it's a lot higher interest rates, things like that. When you talk about self-directed mortgages, more likely you're going to find that they reside in the RSP realm or the TFSA realm or the corporate realm. If you're doing, for instance, just a regular private mortgage, you're pulling out money on your line of credit, or you're pulling it out of your bank account, you're just doing a private mortgage. There's no self-directing situation. The self-directed portion technically means you're directing your investments, typically registered investments, onto the property. Now, basically, they've been around forever and a day. There used to be a lot of companies that used to do this. I believe trust companies are the biggest ones that were doing them at the time. Do you guys ever remember? Do you remember banking with Canada Trust?
Like before it became TD Bank?
Yeah. Okay.
Yeah, man, I remember that. So I'm old
Canada
enough to
Trust,
remember that.
Everybody probably banked with them back in the day because they were so cool. But Canada Trust was literally a trust company. And there used to be these pillars of the financial industry, which is insurance, banking, trust companies. And I forget the third or fourth one or whatever. But anyways, banks bought up a lot of trust companies because banks, like no other, can make tons of money. And what they did was the pillars broke down in regards to the amount of money trust companies can make. So not to digress, but there's not too many just individual trust companies around. And we now, in our beautiful market in Canada, really only truly have 2 massive trust companies across Canada. One being Canada Western Trust, and then the other one being Olympia Trust. So those are the 2 vehicles where you're going to use the self-directed situation. That's what we're going to talk about today. So let's look at this. Outline the ideal candidates for self-directed mortgages. Well, honestly, guys, that could be anybody with RSP money. Let's say you have $50,000 right now, and you wanted to lend it out. You would basically go and register with an administration company, or you could just apply and move your RSP money over to Olympia Trust. And I'm going to talk a lot more about Olympia Trust here because Canada Western Trust, they're slower. They're behind the times in regards to how they fund the mortgage, things like that. They take a lot longer. So as a broker, no joke, I don't want to wait the extra week for money to be transferred by what's called registered mail. I'd rather it be wired over. Olympia Trust uses wires to fund those mortgages. So Sash, you got any questions so far, bro? Because I know our viewers are like, what probably going, what the heck, man? Go ahead.
I just got my pen out to write it down so I didn't forget.
Yeah, go. What do you got? I knew that pen was coming over something. I knew it was.
Yeah, you mentioned like if somebody's got $50K to lend out their money, but is there a minimum? Like, what if I just got $10K and I want to get started?
So if you have $10,000, you're going to want to find someone that needs a $10,000 private mortgage. And the thing is, at that low caliber, you're going to find so for instance, let's look at $10,000. So I'm going to lend you $10,000 from my RSPs. It's going to cost you a lawyer. It's going to cost a private lawyer. So let's just tally that up to $4,000 out the door. So now you're left with $6,000 out of that $10,000. Then you may need an appraisal. Let's just chalk it down now to 5,500. And then you have broker fees and most likely a lender fee. Let's take out that 5,500, take off another $2,000 for that. You're looking at, you borrowed 10 grand, you got 3,500 bucks in your pocket.
Oh, so is this for people borrowing money?
So this would be, where do I, if I go to self-direct my money, where am I going to put it? We're going to house it in Olympia Trust, but who's going to borrow that money from you?
Because what my experience is like when somebody's borrowing private money, are they not covering lender legals and all that other stuff?
That's right. And that's why I said if they borrow 10 grand, it's coming out of that 10 grand.
I mean, what if I only have 10 grand to lend out? What if I'm the lender? Like, is there a minimum that I need to
I would
lend
say,
the money
I get
out?
what you're saying. You come from the opposite end.
Yeah.
So for instance, no joke, the lender fee, all that comes out of that money. The borrower's still paying. So by the time that's done, let's say the lender fee came out of it, the client's only looking at getting 3,500. They still owe 10 G's back to you.
But what if I'm the investor? Like, what if I come to you and I'm like, hey, Duncan, I want to lend my money out. I got 10 grand in my RRSPs.
No problem. I've lent it out, the minus all those fees. So give me an example. You've gotten out of the 10 grand that you've given this borrower, you got back $1,000 for the lender fee and all the other costs. And the client only ends up with 3,500 in their pockets.
Yeah, that sucks for the client.
It does. The borrower's got 3,500. He's like, oh my God, I borrowed 10 grand and now only have 3,500 bucks to spend.
Yeah.
You still get your 10 G's back plus the interest costs of that.
Okay. Yep.
So you're paying on interest. So I would say the cutoff point, you're going to want to start at like 25 grand because then if you borrow 25, if you lend 25, you still get 25 back, but the borrower at least got 19 in their pockets or 18 in their pockets.
Yeah. Isn't it a requirement though? If I want to be a private investor, I need to have 25K in unencumbrance, like money.
So that's down to KYC, like knowing your client and their suitability. So at the end of the day, if you look at a client who says, hey man, I have a line of credit for 500 G's. I have corporate investments. I have investments in a corporation where I can't really touch that, but I have $10,000 only in my RSPs. You can look at the whole picture of the net worth of that client, their assets, and say, okay, they have enough to backfall on. What we try and do though is no joke. You're going to talk to that investor. For instance, if you go, Sasha, are you sure you want to take all of that money and put it in this private? Because now it's going to be locked in for a full year, a full 2 years, things like that. So to continue, 10 grand, too small amount.
Yep.
What you would do is, and then for instance, let's look at you, for instance, if you had that $10,000 with, I'm going to throw a random investment company, a capital private company, or you had it in mutual funds, let's say, right? If you're going to transfer it over to lend out to this guy, you'd have to cash out of all your mutual funds.
Yeah.
And put them in the vehicle of cash account in the RSP. And then we transfer that cash account over to Olympia Trust. And then what you do is lend out that cash account. And then what would happen on the back end is you'd have this market value. You'd have your new borrower's name down there and what interest rate you're getting as well. And it would show up on your profile. So you could actually log into Olympia Trust and be like, oh, there's Jim Bob with the 10 grand I lend him. And here's my maturity date. Oh, and here's my return. Now there is some costs though, man. You got to remember this. And this is why it doesn't make sense for 10,000 either. To the investor, to open up an Olympia account, $168. Okay. Not too much, but to carry that mortgage, I believe it's now $20 a month to carry that.
Like monthly fees.
A monthly fee to carry that mortgage of $10,000.
Yeah,
now, most times the lender fee and the interest rate covers off all those fees you'd cost. But at the end of the day, if I'm telling you 12% on that 10 grand that you've lent out, you're actually only making maybe 10% because of all those other riding fees, right?
Interesting. I didn't know that there were monthly fees.
Oh,
for the private lenders.
They started getting into it like mad, man.
Okay, that's good to know. So that you can explain that to clients when you're organizing a private mortgage, like why they're paying a lender fee on that.
Yeah. And like, for instance, is 10 grand the only amount you have? Let's just put that into some other mutual fund and let it grow first? Or do you want to dump more in your RSP so we can actually get you some more? Because not too many borrowers come in going, hey, I have a credit card about 9,500. I need to pay this one credit card off.
Yeah.
It usually ends up being 50 grand of external debt.
Yeah.
And we want to make it efficient for the client. Honestly, you could if you ever found somebody who gave a $10,000 second, it usually means there was a shortfall on the closing and there was extra funds needed. So they wrote up a third mortgage right away or a second mortgage right away to cover those costs, but it's not efficient for the borrower.
Yeah.
Now, the biggest thing I'm going to touch on is the fact, is that raining?
It's rain.
Oh my God, man. Every Wednesday.
Here's the weather report. It's raining, guys.
It is pouring down. The interest rates are pouring down. We'll quickly slide into that. But let's look at the two types. And I'm going to tell you what's happened. So forever in my career, there was self-directed and there was non-arm's length and arm's length. All right. You could do arm's length mortgages. All right. Then there's non-arm lengths, which means, and I'll tell you right now, if I had $400,000 in my RSPs at the bank and I had a $400,000 mortgage at that bank too, I would take my RSPs and go, you know what, screw paying this mortgage. I'm going to pay myself my own RSPs by paying out that mortgage. You take the $400K, put in a self-directed account, Olympia, and then would do an arm's length mortgage back to pay off the CIBC.
Oh, interesting.
Yeah.
So like instead of having your loan with First National or some other lender and you have all that in your RSPs, you can and you're basically paying yourself back.
Yes.
But it's still collecting interest.
Correct. So you're actually paying
So
your own
cool.
interest. Now, it is very cool. It's so cool that the CRA issued saying it's what's it called? Non-qualified investment. About 2 years ago, the government and the CRA said, no more doing that. You can't do it anymore. I know. So
Dang it.
I'm sorry, Sasha. We can't do that for you today.
Okay.
I'm so sorry.
Cancel that application.
Yeah. So arm's length mortgages are good, but non-arm's lengths, meaning like the client is yourself, your related family member, your corporation, you can no longer do that maneuverability, which means, and I'm telling you right now, man, the banks probably went like, oh, all these people are cashing out their RSPs and taking their mutual funds and paying off their mortgage. We got to stop that. And then basically the CRA was like, all right, we'll make it non-qualified. So you no longer can do that. And what a lot of clients are doing, they're calling us up. They're saying, hey, can we do my own mortgage in this? And we have to tell the client no. So what we would do is say, okay, you need to get out of that investment. We need to actually get you a proper mortgage because you'll start getting fined if you don't get out of those mortgages. We would take it and then put it onto other private people's mortgages to make it arm's length at that point. Anyways, so non-arm's length allowed. Arm's
length.
Arm's length allowed. Non-arm's length, meaning you're hugging the person. They're very close to you. That's not allowed, guys. So if you have anything in regards to a self-directed on your own property right now, or your kid's property, or your aunt's property, or good old Uncle Frank, you got to get it out and get rid of it and put it into a proper investment that's qualified. We do a lot of that over here as well. And the rain is coming down like
It was
crazy.
like, we're done. And then it was like, no, we're not done.
Yeah,
and now it's like,
there.
we're done again.
So maybe we should change the time of this podcast to like non-Wednesdays. I kid you not. It rains every Wednesday.
Yeah,
But,
for some reason. But whatever, we're
okay.
having fun.
I'm hoping you guys are following us. Sorry, we're a lot of ADD style over here, but we're trying to put in some good content. And I want to make sure that if you do want to invest in private mortgages, you can open up an Olympia account. You can give us a shout here at the Mortgage Suite. We'll actually help you out. We'll put it through the application. And what it would allow us to do is actually have you on our platform where we could send you investments and we'd administer that money. Meaning we take care of the property taxes. We take care of the actual insurance on the property for the private borrower. And also, guys, if you are going into a private mortgage, let's look at it and be plain here. Most private mortgages shouldn't run for more than 3 years.
No.
Like who can afford 10, 12, 11, 14% for 3 years?
Of interest-only payments.
Yeah,
on
interest
top of
only.
it.
You're right, man. A lot of times, too, what we do is second mortgages. The cool thing is when we do a second mortgage, you want to look at what the first position is. If the first position is a low rate, maybe it's with, let's say, MCAP, and we do a second mortgage on that property, you're going to realize a lower loan to value every month that's paid because they have a blended payment on the first, meaning your exposure is dropping as they go through. They're paying you interest only, but they're paying their first mortgage down on the principal every single month. So that's some things to consider. But the 3-year rule, when is the client getting out? How are they getting out? What's the exit strategy? Sometimes the exit strategy does not work. And we explain this to the clients or the borrowers and we say, listen, this guy's got to renew on this private, but at all times, you got to realize the longer they stay in there, the riskier your investment actually becomes letting it sit in there. Okay.
Yeah. Just want to bring up another point on that.
Yeah.
We were talking about it in our meeting earlier. Like, why is this client going into a private mortgage? Like now that, that's coming to being part of our compliance, it's good. Like the client needs to know, like, why am I going into a private mortgage? We saw a lot this year coming in, mostly from the GTA area, but they're coming in and they're saying, I'm in this private mortgage. I need to help get out. We look at it. And then the question I'm finding is like, why were you even in the private mortgage?
Yeah.
Your stuff is good.
And that, like, I'll be honest, it's a good question. So, like, what we call that, instead of an exit strategy, it's an entrance strategy.
Yeah.
Why are we placing this person into this second mortgage? Is it because they can't get approved somewhere else? Do we need quick money just to bring up their credit score so they can exit? So a lot of times I find it's a conflict in regards to that, because sometimes these brokers have buddies that want to lend out money. And you got to remember, lenders are turning around to brokers saying, hey, get my money out, or I'm going to put it somewhere else. So what they do is they find an unwilling borrower who doesn't know anything about what they should go into. And they're kind of, the fiduciary duty leaves the room. The fiduciary duty is not present in the actual application. So what they do is they give a client a private second. Client's happy, you know what I mean? They got this second mortgage, but would it be worth it just to look at the whole application and redo the whole application at that point? So you have to understand, if you're going to get into private mortgages and do seconds, and you're going to do them in a self-directed vehicle, it's your RRSPs, it's your TFSA, it's your corporate investments. Understand like why this client has to get in there, and understand, is it worth them to get into? Is it suitable? Don't look at just the return, guys. Look at the actual value you're getting from the actual broker or the administration company at that time.
So I hear a lot of people talking about getting into private mortgages for investments because it's secured to real property. But a lot of people have this notion that there's no risk because it is secured to real property. So what are some risks that are associated with self-directed mortgages, and how can people mitigate that risk?
Okay, so that is a meaty question, man. Sasha, yeah, thumbs up on that one, buddy, because that's a meaty one. Okay, so there's a couple of different things. There's inherent risk to the property. Okay, don't get me wrong. Everybody loves to fix up their houses. Everybody keeps their house really nice. But you got to remember, they're getting a private mortgage. So what happens if they do default? What happens if they don't get that job raise and cash flow, or what's called affordability, is affected? Well, the client's first inkling is, well, I'll keep paying that first mortgage at MCAP, but I'll let my second mortgage, go in arrears. The problem with that is, a second mortgage is for 30 grand, let's say, or 50 grand, like we talked about. The first mortgage with MCAP is 400 grand. Okay, so the client owes 450 total, right? The second mortgage is now gone in arrears. In order for that lender to control the power of sale, he has to buy out the whole MCAP mortgage to obtain his money. So these second mortgages are risky, but that's why they come with like 12, 13, 14%. But you have to get a borrower that's going to make sure that like the affordability is there, that they can afford both those payments. Because if they can't, you're out to lunch on getting the money back. You have to wait till the client either sells or goes to refinance. Now, don't get me wrong. You're protected by the covenant. You're protected by the mortgage charge. But man, no joke. We have a situation where a client has a second mortgage literally for 25 grand. The first mortgage has gone bunk. That hasn't gone bunk. They're trying to pay it out right now. So the second mortgagee is literally sitting there. Interest bearing on his 30 grand. It just keeps floating over, but he's waiting to get paid out because he doesn't want to take over the whole first of 280 grand. So you have to wait now. And 30 grand is not a lot, but when you're getting into higher seconds, like 250 grand, that's a lot of money to let sit there on a property that could either deteriorate, things like that. The next thing is, if you're private lending just yourself, you're going to want to make sure you check property taxes, because they're super lean. They can go against the property and basically be first position. You want to check CRA back taxes, and you want to actually make sure that the insurance is always current on the property. Now, not to zinger through here, but I put a plug in, but Investor Suite, that's our administration company. Mortgage Suite's our brokering company. Investor Suite is an administration company. They do all of this. They handle it all for the investor. They make sure it's properly done. They make sure the insurance is up to date at constant times. They get notified if it's in arrears or the insurance policy's lapsed. We actually go and cover the investor right away. So self-directed RSPs, the administration of that is beautiful because it allows the guy just to get his return on the investment, or the lady or whoever's investing. The investor gets a return without the headaches. Now, if they're doing it themselves with individual brokers and agents, they have to track all that themselves. They have to take care of their insurance. They have to do all that. So those are the biggest hangups with privates. Then right now, let's look at market, man. The market itself, back in the day, I'm not going to lie, man. Like, we got an appraisal was like that's a sure thing. That's been appraised at that. I've seen so many appraisals come through my desk where I have a lot more private lenders saying, okay, well, that's just an opinion. And you have to understand, an appraisal report is just an opinion. So like there's that inherent risk there as well. Like, oh, is this appraisal good? Maybe have it looked over by another appraiser to get maybe two opinions that are going, okay, that's the proper value. Yeah. So value is huge right now, right? It's like, that's basically the biggest thing.
Yeah. I got two questions actually. If I'm an individual, like investor, do I have to have any kind of special license?
No. If you're an individual investor, you'd want to register your KYC, and it's a brokerage mandate. For instance, if you want to privately lend, I'd have to be like, okay, do you want to see my borrower deals? Please sign this KYC so I know how much you have, what your assets are, and please sign down there that you're okay with this risk of this investment. If you're just willy-nilly lending out money as well, it gets into issues. For instance, I have lots of examples, Sash. Whew, tons of examples.
You do. 20 years experience over here, guys.
I had a guy call me up. He self-administers his own mortgages, and it was through his corporate account. Calls me up, and he's like, Duncan, this client's behind on their mortgage. No problem, man. I'll give him a show and see what's up, but I'm going to call him because a mortgage broker cannot directly call on a borrower and say, hey, you're late. So we call him up, and we don't call him up. I ask him, when's the last payment he made? Well, he's 3 months behind. Already that private lender has lost out on the proper power of sale proceedings. He's lost out in the process. It now looks like he's just willy-nilly lending out money. And to a judge, if you go in front of a judge and they're going through the power of sale process or anything like that judge is going to be like, why did you lend the money? You didn't do it properly. So there's this proper process procedure that needs to be done. And a lot of private guys, they want to make the returns, but they don't look at the process procedure of how to do it properly and to protect their asset and do it, no offense, professionally. Yeah. So it's like, when do we go power sale? I need to give this client proper notice. A lot of that stuff's not done when it's just done willy-nilly. It's just like, oh, you're late. Okay, I'm going to note it down. I'm going to call my lawyer. And then the lawyer, he's already bogged down by a bunch of other paperwork, so he can't get around to it properly. So the whole process, if it's under administration, it's done properly. Yeah. If it's self-administered, sometimes it just... it gets a little bit hairy. Like I've had private guys who self-administer call me up and say, hey, where's all my money at? Cause I forget. And it's like, you don't keep track of it. They don't keep track of where all their actual dollars are put. You know what I mean? Yeah. So that's why we tell them, please get into our administration so you can get an actual bank or a statement of account on all your private mortgages that you get. Yeah.
And about appraisals, like there's, I hear people asking, can I just get my realtor to come do a walkthrough? What's the difference?
All right, so I'm going to say optimism's the difference. So if a realtor goes to do an appraisal, they're looking at going, okay, how many buyers can I get involved here? They're going to list it for $100,000 less to get a ton of buyers emotionally engaged in this offer to purchase. The property, let's just look at $400,000 value. Yeah, appraisal comes back $350 because what it's doing is it's taking into consideration every house down the street, let's say, also comparable houses everywhere else and the market itself. So no offense, optimism is the biggest thing there. An appraiser is looking at definite numbers, non-emotional, non-sales impactful, just straight up, here's what it is on the market and this is what everything else sold for. And I'm not saying they sit there and go, okay, this thing has gold hand knobs and stuff, but they look at it going, okay, there's 4 bedrooms. This is what it sold. I've had a lot of realtors, by the way, in the past being like, how the hell is this only appraised at $350? Right? The other issue is I had a lot of realtors who call me back on appraisals going, how is that appraised at $350? I can only sell it for $265 because I'm telling you, it's up and down like a yo-yo right now. And the market itself is very unpredictable. It's probably the most unpredictable I've seen it because we've gone through so much influx of massive home prices. So now everything decreases back down. And you got to remember this. I would say my whole career, buyer confidence in the market has never been so impactful other than the last year or so. Meaning, interest rates came down by a quarter. It's great and all that. But there's still people going, oh, I don't know if it's going to drop even longer. And that's buyer confidence. Like, oh, I'm not going to get back in the market yet. Yeah. They're waiting for it. So you kind of see this whole thing. And no joke. I kid you not, when the rate dropped, I probably had 150 posts telling me from every lender, like the rate dropped. It's like, thank you, man. Like I can see my own news.
Yeah, right.
Yeah, you see all these rate drops. So you have buyer confidence going, oh my gosh. Like you get it. Everybody's so much more, I guess, aware of where interest rates are, and mortgage purchasing has gone through the roof in regards to knowledge and everything else.
Yeah.
And this self-directed situation too, the reason why we're doing a podcast on it, it just shows you the next level of situations that are happening where we have people having mutual fund returns that are shit. Their investment portfolio is not good. They're wondering why they're paying an MER to their investment advisor when they're getting no return. So this is the next level for investors too in this market, where buyers' confidence, not so much there, but investor confidence saying, hey, I want a return in this market now too.
Yeah.
Right. So it's kind of give and take. It's ebb and flow. And I hope it comes back. And I'm being told to wrap it up now by Maddie. So just to wrap it up, do not lend your own RSPs to yourself because you'll get in trouble. Give us a shout here. We'll lend it out. And Sasha could bring in a beautiful borrower for you on a 1, 2, or 3 year plan. And we can go through the whole process and the learning process for you. But if you do have currently a mortgage in a non-qualified investment, meaning you've lent it to yourself, your own corp, or your family members, you need to get it out because the government is going to come down on you.
Yeah.
Like they are going to come down.
Yep. And
that's
it's another important thing is just make sure you're doing your due diligence. If you feel like your agent or broker that you're working with isn't giving you enough information, seek a second opinion. Give me or Duncan a call or one of our other agents here. We're all super communicative.
Yeah, exactly. It's not like a doctor's second opinion. We're talking like a phone call for like 10 minutes.
Technically, it's kind of like a doctor, though. I
No,
mean,
but
it's
we're
your
just on
mortgage
the
health,
phone.
right?
We're on the phone. We're like, hey, that doesn't sound right. Let me figure this out. Send me some docs.
Turn
But,
your head
like,
to the left and cough, please.
Yeah, right. On the phone.
Sounds like you need a lower interest rate there,
I
bud.
agree, buddy. So that would be about it, guys. That's it.
Yeah.
We're good?
Wrap it
Is
up.
that a wrap?
Great.
Perfect.
Good job.
Thanks, guys.
Go for
Thanks,
the
guys.
mortgage.
Ladies and gentlemen borrowers, thanks for tuning in to the Mortgage Sweet Spot. If you have any suggestions for upcoming episodes or questions for our hosts, me and Sasha, throw them in the comments below.
And if you enjoyed the podcast, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, or you can check us out on YouTube. Once again, thank you for tuning in, and we'll see you on the next one.